And welcome to the Horowitz Company pop-up Q&A webinar for August 3rd, 2020. And hopefully everybody's doing well out there. Obviously a lot happening. We had the end of an amazing month. That was July, and here we are in August. And it's pretty amazing how we've seen this rise from the bottom, this incredible amount of stimulus has been helping to, well, we'll say, to lift all ships and at the same time provide for just about close to all-time highs on, well, the NASDAQ clearly. The S&P is a few percent away, and the Dow Jones has a long way to go. Small caps themselves also have a while to go before they get to that point. You know, if a pandemic wasn't enough, now we got hurricanes. We were putting everything away, getting ready, doing all the things we have to do in anticipation of this hurricane hitting the shore, and it did hit. We got, well, it didn't really hit. Fortunately, it was nothing worse than a usual Florida summer storm, and everything is fine down here. But there was obviously the continuation of this going up the East Coast right now, dropping down a bit. But, well, we know it's been a strange 2020 to say the least. I thought we'd get started today with something before we get to the questions with a couple of polls, just to get a pulse of everybody and what you're thinking. So I'm going to launch a poll right now, and these are anonymous. So the question is the relationship between the economy and markets, in your opinion, permanently broken? So we'll give that a couple of minutes to pick back up, and then I got another poll on the other side of that. But let's talk about what happened. Obviously, big ending for the month. Just about every asset class was higher, inclusive of commodities and alternatives, real estate. The markets are looking for a continuing stream of, I guess it would be stimulus. That's the word on the street, that another maybe $1 trillion of stimulus is going to be coming out of the fiscal. Of course, the reaction to that and the reaction to earnings, where we're seeing just about every company, pretty much a good chunk of companies at least, beating the very low expectations. Now about 82% of the S&P 500 companies that have reported, which is about 275 or 280, have beat estimates. And that is one of the best beat records in history. And that doesn't happen by just accident. That happens by the fact that, first of all, analysts are, well, blind to the fact of what companies are doing. There's no guidance being put out. There's no visibility. And at the same time, they figure that with all that's going on, just like everybody else is thinking that, well, companies are going to have a hard time meeting their estimates. But you know what? We're seeing a lot of companies in many different sectors actually beating estimates. And earnings, one thing, revenues, they're also doing pretty well too. So that's good. Now, when we look at, for example, the relationship of earnings to estimates, that's one thing. There's also earnings to what has happened historically. We're still seeing somewhere in the neighborhood of I think a 40% reduction in overall earnings from a year ago. So I'm not quite sure if that in itself is reason enough to believe that we should be at all-time highs at this point. It seems, as a matter of fact, that there's something a little bit strange about not only the economics, where we're seeing that GDP, that print last week of a negative 32%, unemployment coming out at the end of this week, which is going to be very important, and all the other things that are aligned are seemingly misaligned. And that's why I asked this question. So we got another about 10 seconds on this poll, and then I'll tell you the results. So if you haven't had a chance, at the bottom of your screen, there should be something that is blinking, or a poll there that you can vote on, which is about the relationship between the economy and markets. So we'll give it about another 10 seconds there, and I'll tell you the results. But just to finish up on this whole earnings discussion about, you know, this low bar and low guidance, well, sell side, it's a game. It's a game they play. It was nicely executed. The idea, let's really lowball the earnings that are going to be coming out. And what we'll do is, if it does better, well, a lot of investors just look at the headlines only. They don't look at historical reference and see what has been the consecutive quarter over quarter, year over quarter numbers to see what the progression is. They figure, by just looking at headlines that if a company beats, things are going pretty well. Now, some companies are beating. They're raising. We've seen that tonight. There was a slew of companies out tonight that were beating and raising. And again, this is raising what? Raising to where they were potentially, but also above consensus estimates for the future. So that's a good thing because obviously markets are based on pricing mechanisms. Those pricing mechanisms are based on a calculation of estimated earnings power for the future based on things like a dividend discount or an earnings discount model or cash flow discount model, looking at what is the risk-free rate, which we know is basically zero right now, and taking that in consideration of what the earnings flow is, and then calculating what is the value by doing a present value calculation and a future value calculation, moving back and forth to figure out, okay, what is the number that should be by the end of this year, all things considered, the stock price, considering all that, and then maybe even a year out what that should be. So now, what's happening is there is this situation where we are having now a gameplay, like I said, by the sell side. So that is, again, been executed pretty well. Let me give you the results of this poll right now. So about 30% of you have said that, yes, the relationship between the economy and the markets are permanently broken. About 70% said no. Well, that's kind of interesting because if I were to think about what those answers mean, is the relationship between the economy and markets permanently broken? No, being 70%, meaning I think a lot of people are probably saying, hey, you know what? I think there's going to be a reasonable recurrence of the importance of the economic situation. Remember that right now, one of the things that's happening is that the markets are following the results of the pandemic. It's kind of strange because, in a way, the more we see problems with a continuation of the pandemic, because let's face something, this was supposed to be all and done with Easter, mid-April. This was supposed to be done. Remember that? We're talking about August 3rd right now, and I don't see any real break in the action. Whether it's a first wave, second wave, it doesn't matter. A lot of things are still closed. Airlines are still suffering. Everything in leisure is suffering. We saw a massive breakout of a ship out of Norway over the weekend. 250 people overall, mostly crew, tested positive, and they left all the people off and disembarked before all the testing came in. So now there's a massive quarantine going on in Norway and the surrounding areas for all the people that were on that vessel. So one of the things that you're seeing now is that there is this break at the moment because the idea is, well, things will get better, it's temporary, and if it doesn't, there's going to be major stimulus. If the pandemic continues its course as it is, we're going to see just trillions of dollars and interest rates at low, if not zero, and the Fed continuing to push in. So that's kind of really what's ruling the markets right now. That's why we saw every asset class, which I'm going to show you in a second, come up in the month of July. Now, there's a second part of this. The question I had before was, is the relationship between economics and the relationship between the markets broken? The next question is, are market valuations justified at these levels? A new poll that just popped up there. The first answer seems a bit high, seems about right, seems a bit low, or no idea. Which, in a way, I think, well, I'm not going to tell you right now. We'll get to that in a second, where I think we are with that. But take that poll, and then I want to show you a few things. We'll come back to that. So, I didn't mention this. Before anything else, we got to mention that everything is for educational purposes here. It's not a recommendation to buy or sell any security. Past performance is no indication of future results. Okay. Got that? Obviously, investing involves substantial risk. A lot to read there as you're doing your poll. All right, July 2020, what happened? Well, U.S. Stocks did extremely well for the month, up 5.68%. Global stocks did 4.46%, ex-U.S. Real estate was up Global bonds were up. U.S. bonds were up, 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 up. Everything was up. Growth beat out value. Blend was up 5.8. Growth was up 7. And that was across the board in terms of large, mid, and small. Small caps were the laggard to a degree, picked up towards the end of the month. But basically, as you went up the ranks of small to large, there was better returns. Latin America was the number one. Emerging markets did very well. And that's kind of interesting because one of the things we also saw was that the dollar has been dropping. And the dollar dropping has been very beneficial to non-US dollar denominated stocks. That being the case, there is something to be said about investing and diversifying outside of the US. We see a nice return like we're seeing here of emerging market stocks of 8.94% for the month. That's a good annualized return for any position, any sector, any asset class, and handily beat out U.S. stocks. Asian stocks were up about 4.5%. Europe stocks were about 3.84%. So we saw that the riskier stocks, those stocks, for example, in Latin America, up almost 11% for the month. And what's really interesting about that is while they got the tailwind from the U.S. dollar coming down, what's interesting about that is that's the worst hit area of the emerging markets in terms of the pandemic. Look what's going on in Brazil. Look what's going on in Latin America in totality. It's a terrible situation there. But meanwhile, the idea is the worse that the pandemic is, the more we're going to see governments stepping in with stimulus. That's the game plan right now. I don't necessarily think that's going to last forever, but that's the game plan right now. 15 more seconds on the poll. If you haven't taken that poll, please go over and do that so we get a good reading on everybody about our markets, values currently justified. So a few people that haven't put in your votes right now, please do so. Also, as we're waiting for that, your questions, load them up in the Q&A, section of the Zoom meeting. You can find that probably in the bottom. Any question you have, no matter how large or small, we will try to get to the bottom of it and answer it for you. Finish up that poll. I'll show you one more thing and we'll come back. These are the number one to the best to the lowest performing sectors for the month of July. Interestingly, utilities, communication services are the top. Pretty interesting. The reason why I say pretty interesting is because we saw a market lifted really well by the largest weighted companies, and that's technology, but yet underneath the surface, those staples, those more, I'll say, the more defensive names really pulled up dramatically. Look at materials up 7%, consumer defensive up 6.92%. On the bottom, you have the other names, right? The healthcare, the technology did very well, respectable numbers of 5%. Industrials only up 4%, real estate up 4%, financials up 3%. That could be up to the top if there was a full defensive play going on, but the financials don't really have a good chance right now to do anything due to the fact that we are in an environment with a flat yield curve and the potential for them making money is very difficult in this environment. Energy down 4.81% for the month. Now you'll notice something on the right-hand side of the screen. You'll see that technology now has a weighting of 23.5% of the overall market in the S&P 500, a market cap weighted index, healthcare as well. Between the two of those, you're talking about 36% of the overall allocation of the S&P 500. What's really kind of interesting is we're seeing names like the Microsofts, the Apples do extremely well right now. Microsoft was up close to another 6% to an all-time high today after there's this notion that they may be buying TikTok, even though they fell after their earnings. The big turnaround over the last several days on the notion that there could be this opportunity for them to buy TikTok, or TikTok is going to be banned entirely. And if you haven't checked out TikTok, it's a short video, funny platform like the old Vine, if you remember that. I'm having a hard time understanding why Microsoft will buy this. I know there's a lot of user base, but revenues are pretty light. And it doesn't really fit for their strategy overall. So whereas Skype and whereas LinkedIn kind of fit into their overall strategy and how they're going to work it into their ecosystem with businesses and communications, I don't really understand how TikTok works within that unless they just obviously have so much money, they're just figuring, why not? We'll just do it. But we did see that the big caps obviously pulled a lot of weight during the period, but yet at the same time, we look at utilities, only a 3% overall positioning inside the S&P 500, even though it was the number one, pulled it up a little bit, but only a slight amount for the month. This is an ongoing problem because what's happening right now, we're getting really top heavy. Wrote about this in the last newsletter that we sent out to our clients. We're getting really top heavy in the area of technology in particular and healthcare. And the question's been asked whether or not this is really then representative of our stock market and our economy. To a degree, I think it is. But the question is it really representative if you have 5 stocks, the Amazon, Apple, Microsoft, maybe throw in Netflix in there, Google, Facebook. Are those stocks the entire economy? Not really. So there's something that we have to look at to really question whether or not this is really representative of something that is even remotely related to a diversified portfolio. In fact, I would dare say that most portfolios, when you look at performance, have nothing to do with a market cap weighted performance structure. What they are is an average asset class performance structure. So therefore, unless you have these kind of weightings, the S&P 500 right now is not necessarily totally applicable to your performance metric on a portfolio. And a lot of people are getting, a lot of FOMO with this, saying, wait, the S&P is up 5% for the month, and I'm up 4, 3 for my portfolio. How come I'm not up as much? Now, at the same time, there are those that have a heavy weighting in emerging markets, so you saw a larger return potentially for the period. If you had that, and obviously there was some nice move on other areas. So it is a question that's going to be ongoing for a while because you live by the sword, you die by the sword, right? If technology continues to do what they do, due to the fact that we have a stay-at-home environment right now and there's a lot more need for technology, and we fast-paced and compacted the need for technology in all sorts of areas due to this pandemic, then therefore what's going to happen is you're going to see that there's going to be the ongoing growth of that sector and therefore a continuation of this overweighting in technology. And of course, with healthcare, you have the ongoing need for drugs and biotechs and pharmaceuticals due to the pandemic. So those two are really doing very well right now. But if we do see that there's going to be a solution to this, I would see some of the bottom side of this coming up very significantly. The materials, potentially energy, industrials, as well as financials. Something to think about. All right, let's take a look at the poll. Our market values justified. 77% seems a bit high. About 3% says seems about right. 5% seems a bit low. And 15% say, I have no idea. I think that's a lot of the thinking, and I think that's pretty much right on with all the people that I've been talking to. A lot of people, whether they're clients, whether they're other professionals, people in businesses related to finance or have a good knowledge, there's a lot of head scratching going on. A lot of people are squinting as you talk to them about, where are we? Well, they say, I'm not really necessarily getting out at this point, but at the same time, I really can't put my finger on where there is any basis for some of this valuation. And just to go back a step, the basis for the valuation is due to the fact that 40% or 37%, 38% of the S&P 500, when you look at valuations, is technology and healthcare. And therefore, that incredible weighting in that area is significant. Now, to prove this point to you, I think bring it all home, is one more chart we're going to look at. And that is right here. This is non-dividend based. There's no dividends involved here. This is the S&P 500 equal weight index versus the S&P 500, which we all know about, which is a cap weighted index. Look at the differential year-to-date returns. Right now, there's close to an 8% differential, right? 7.8% down for the year for the S&P 500 equal weight. whereas the S&P itself is up 1% for the year. So there's over an 8% differential right now in terms of the difference between the two. Therefore, what this says is that the larger caps, those names that we just talked about, the technology and healthcare, maybe even, well, to a lesser degree, the banks not really, because they're not doing well. But the biggest of the big are pulling this all up, and it's top heavy to a major degree. That's why if you just held the entire S&P 500, you bought $1,000 worth of each. Right now, by the beginning of the year to where we are right now, you're down 7.8%. Whereas if you held the S&P market cap, I think there's going to be some talk about this. I really do. I think there's going to be some people saying, you know what, maybe market cap is not necessarily the best way to value the S&P 500. Because it's not really representative of what's really going on. So the biggest of the big are getting bigger. We've got a major differential that doesn't equate to what most people have in their portfolios. And measuring this by cap weight may not be the best thing for the future. Just something to think about, something that I've been kind of looking at. I don't necessarily think it's going to change as long as it's good and it looks good on paper. The S&P indices are not going to be changed, but I think that when you look at some other alternatives, there's something to be said about looking for a reversionary trade if, in fact, we do get beyond that whenever this is. Right now, my vision, if you care to hear it, it's going to be a while till we get beyond this. A lot of talk about antibodies, a lot of talk about testing, a lot of talk about illnesses and deaths and positivity rates. It seems to me that unless we can get a vaccine that is, in fact, effective at providing long-term antibodies against this particular pandemic. Listen, Fauci, whether you like him or not, listen, he's going by his science, okay? He even talked about this is possibly never going away. Many viruses, listen, we know this, right? Many viruses never go away. We're just immune to them, or at least have built up a tolerance to them. So I think that's what's happening here. The problem is the transmission rate, the ability to, the contagion rate, the ability to have a transmission rate on this one is much higher than others. And it could be because it's new. So right now we are in the midst of all this. And I don't know about you, but I am a little bit over this, going to work, coming home, going to work, coming home, finding a restaurant, maybe eating outside somewhere away from people, the whole time panicked about something. Did they touch this? Did they look at that? Kind of like, all right, maybe I'll do this few and far between. But, there is a lot of that going on out there. People that are older probably have more concern than younger. We know that. We've seen that. And the whole idea that children are immune, yet we saw a camp in Georgia have 253 counselors and a lot of kids come down with a positive result over this weekend. So lots still has to be learned right now. Lots still has to be, dealt with right now. So where we are is still in a holding pattern. All right, with that, we're going to answer some questions. We'll get to that. Let me kind of bring up the next screen. And if you have any questions, we have a lot of them. A lot of questions today. All right. We are also recording this. We'll put this up tomorrow. Aaron, and that'll be over on the disciplinedinvestor.com. And any questions you have after that, right on the screen in front of you is the email, info@horowitzco.com. HOROWITZCO.com. You can reach us there. Our phone number's there too. And there's plenty of ways to get in contact with us over on the disciplinedinvestor.com. Aaron has the first question. All right, let me take a look at this. He says, investing in China. We hear about the lack of transparency and accounting standards out of China-based companies, and yet a large proportion of pension funds investing allocations are in Chinese companies. Can you share your thoughts on this? Also, investing in Hong Kong listed companies, are they any safer? For example, Alibaba. There's a lot of areas around the world that there is questions about transparency. Let's be honest for a second here. Can we talk? The GAAP, non-GAAP, EBITDA, non-EBITDA way of reporting in the United States, the footnotes and the accounting here is relatively transparent, but very difficult for anybody, unless you're a forensic accountant for the most part, to really understand some of the data if it's being hidden. The Chinese data that you're talking about here, there is accounting standards that they have much different than they have in Latin America, much different than they have in Japan, much different than they have in Europe, and that you have in the United States. And there is a lot of question about the transparency. One of the things you want to have if you're investing in China, not necessarily if you're just going after a company like Alibaba or Pinduoduo, or take your choice of a company that's traded there, is the concern about, if they are a company that is fraudulent, that's a problem. Now, obviously, you want to stay away from some of the small companies there. The bigger companies, the other problem you have aside from transparency is the fact that they're state-owned. So therefore, even if they are being transparent, they're being transparent to what degree, and if in fact they're going by their laws, and the laws are based on what the state wants, and they want that company to do well, is that really beneficial for the rest of us? I mean, in a way, yes, because they're going to keep it propped up, make sure the right things are happening for themselves. Therefore, we could follow along. However, the problem comes in if you're really trying to understand the companies, it's very difficult. That's why for those sectors, for those areas around the world that we invest in, we use mutual funds, not ETFs. The reason is that we want to have boots on the ground and understanding of the politics that are going on, and understanding of the accounting standards and procedures, the tax laws, and really important, the language. So we deploy our assets for our global allocations and for Investology, for those that are diversified into money managers that have the ability to have teams or people that are actually there and understand what's going on as much as possible. The pension plans, you would hope, also have allocations that and teams that they can understand that. We're not quite sure if they do. Alibaba being a great example, dual listing here in the United States, also in China, also in Hong Kong potentially. I don't think the listing in Hong Kong necessarily means much. There's a lot of risk right now for those that are dual listed that are also here on the U.S. markets due to the fact that there is a basic China hatred going on right now, right? That nobody likes China in the current administration, and we're constantly doing what we can to badmouth them. The latest is this whole TikTok nonsense that's going on, that theoretically that TikTok has the user data from 100 million people, which they only had 35 million last count, but maybe there's an update recently. 100 million people that are utilizing that, and somehow TikTok is getting the data, which I'm not sure what data they're getting, but they're getting data, maybe about their lip syncing. It seems to me it's more that TikTok really had an incredible situation happen recently on a couple of different occasions where they became a political force to reckon with. If you remember, one of the things that happened is that there was a TikTok by users, a user or originated plan to get everybody, and it spread like wildfire, that uses TikTok to understand is, hey, you know what they said? It wasn't from TikTok. Well, maybe it was, but it was a user, and it spread. Hey, everybody sign up and register for the Tulsa, Oklahoma event for President Trump, and nobody show up. And what happened was they got flooded with a tremendous amount of registrations, and then nobody showed up. And it was embarrassing to the president. So I'm not quite sure if, and there was another thing also that happened recently. I think the question is going to be, what happens if it's user-generated, whether it's from a foreign power or maybe it's even somebody in the U.S. It doesn't really matter, but somehow it goes viral. It says, you know what, go out and vote for this person because of this. Go out and vote for that person because of that. Don't vote. I don't know, whatever they have. I think there's some concern from the political side of this, and that's the big issue that's happening right now. So I think that, there are some companies that you can invest in that at least have historical reference, that you can see a lot of information. But like with any company in any country, you really have to know what's going on inside of that if you can take a big position. Alex asks, hey, Andrew, I feel frozen. Sorry, Alex. I panic sold off a good chunk of my non-retirement accounts, the S&P around 2,700. I'm anxious to get back in and realize we're probably not getting back to 2,700, but I still think things are so overvalued that I don't know what to do. I was thinking about waiting until election time to really dive back in, as maybe things will normalize. Any thoughts? Thanks again. So, Alex, this is a great question. I couldn't have actually planted a better question because this is something we've been talking about for a while. The idea that it's very difficult to understand about, for a lot of people, about what the market is doing and separating that from what's happening with the rest of the world, frankly. And one of the things you want to do is look at not so much levels and what's going on right now, but take a second and step back. And step back and don't think about, stock markets dropping or going up or any of that stuff. Think about what is your long-term goals, what's your time horizon. So let's say that you're young and you have a time horizon of 25 or 30 years till you're going to start maybe utilize this money, particularly retirement accounts. Do you want to have those in or out of the market? Not today, but over time. And if you don't want them in today, we talked about many times this whole idea of 1 foot in, 1 foot out. Dollar cost averaging, using multiple disciplines to get you into the market. And by doing so, it alleviates the stress because you'll be investing on a time-based dollar cost averaging situation, maybe monthly, let's say, as an example, and utilizing opportunistic dollar cost averaging. Whereas if you see the markets come down or a sector come down, for example, let's say this real estate's not doing very well right now, we add a little position into that. And by doing so, you get yourself in position. However, at the same time, we take your portfolio positioning and maybe knock it down a little bit from a risk standpoint so that you're not overwhelmed. And at the same time, you have a plan of action to get back in, because here's the trick and here's the secret for your situation, particularly for somebody who's frozen. It doesn't have to be all in or all out, because what happens if the election time comes in like you're talking about here and diving back in and the valuations are the same as they are today? Or maybe you don't like who was elected, or maybe the markets drop. And let me tell you something. I would bet dollars to donuts that if the markets drop down to 2,700 again, which is very possible, that, well, at that point, you're going to say, you know what, I was right. I'm glad I didn't invest. I'm not investing now. Let's see what happens if it comes down. And the potential for missing it is very high. So you need to think about how to get yourself in a plan to, if you ever do something like this, or if you get an inheritance of cash, or for whatever reason you have a big chunk of cash that you utilized in your account from a savings standpoint and you want to move in, right now it's a 1 foot in, 1 foot out dollar cost averaging program. And if you want, use the email and contact us, Alex. We'll answer that. Next question. Hi, Andrew. I know you've recently been suggesting people consider getting some exposure to foreign markets. I'm wondering if you're looking at diversified foreign exposure or perhaps a focus on foreign growth. I think you could do both. One of the things we like is working in a few different categories, but there's foreign. Well, foreign can be broken down into a couple of different areas, right? So you have foreign, which would be developed markets, and you have foreign, which is developing or emerging markets. In addition to that, you have foreign bonds and you have foreign equities. You have some that are hedged and unhedged. I don't mean to make this very complicated, but here's the deal. We like utilizing things like diversified foreign, so that's the developed markets, and SMIDs, small to mid cap levels, and emerging markets. There are some unbelievably solid groups out there that have done a great job managing the risk through this entire process. And the funds that we utilize in our portfolio, you have to look for the right characteristics. You have to look for a management team that's been there for a while. You have to look at their risk-adjusted performance. You have to look at the concentration by country, concentration by sector, looking at what they have for a hedging policy, look what they have from a currency standpoint, and make that consideration. But I think that you want to look at a diversified foreign exposure in this kind of environment would be something that I would be leaning towards right now. Hopefully that answers that question. Doug asks, do you have any guidance on using stops? I use trailing stops, but never sure what percentage to use, especially with these wild price swings we're seeing. Yeah. I assume some large caps versus small caps versus spec names would have different stops. It all depends. If you can look up something called the average true range, that's something to look at. It's also important to look at key support and resistance areas. Right now, we are using some trailing stops for hedging positions, but from a standpoint of a trading position, I much rather use a key support and resistance level based on volume and price. And I know that sounds complicated because it frankly is a little bit, but you have to find out where that line in the sand is on a long-term basis, because whether you use a 50-day moving average right now seems to be key, or a 10-week moving average seems to be something that the institutions are playing with pretty well. Some, unfortunately, prices are well above those levels. I looked at Tesla today. Tesla is like 200% above their 200-day moving average. That's absurd. Totally absurd. That doesn't mean necessarily that Tesla's going to come all the way back down, but the 200 days is going to obviously move up over time. But you're seeing a pretty wide variance in levels here. It is very difficult in a market that is very volatile, when you have VIX above 25 or thereabouts, to have these kind of stops on. I would suggest you use smaller positioning, a few more names that you could watch a little bit more carefully, understand the ranges of where they trade to understand where those stops are, and go a little bit outside of the levels for any of these. Another question. I follow a few investment newsletter writers, and one says that dollar cost averaging may make you feel better, but he says that if you're going to invest, go all in with a diversification. He says in the long run, you'll make more money than dollar cost averaging. Your thoughts? I think that's BS. It's a newsletter writer. I mean, some of these newsletter writers, they got to write something, right? So I think it all depends on your risk tolerance and your time horizon. There are certain, I'll give you a situation. So for example, just today, we had a client that was fully invested, and they wanted to change their entire investment process. In other words, money came to us over the last few days from a different party. They hired us on. They decided, you know what, we want to be invested, but we don't want to be in the current allocation we're in now. Okay. In that circumstance, we stay invested. Now, on another situation, you have a all cash account, right? So all cash, I'm not talking about nibbling in a stock and building a position over time. That's different. I'm talking about when you have a broad-based allocation process, which is diversification, okay? And you want to be, you're really not comfortable with the market. And you could say, well, who cares if I'm comfortable? Well, a lot of people can't deal with excess stress right now, particularly in an environment that we have here. We have the COVID cane, the combination of the hurricane and the COVID virus. We have markets that are all over the place. We have an election coming up. We have all this crap going on Twitter and all that. Some people just don't want the extra stress in their lives, and they want to be in the market, but they want to be in a position that they don't have to worry about it. So dollar cost averaging, you know what? If in fact the market goes straight up, dollar cost averaging does not work. How could it? If it goes straight up, if you have a really long dollar cost average plan. If you have a short dollar cost average plan, doesn't matter. If you have a long time horizon, doesn't matter either. Because if you have a year-long dollar cost averaging program, or whatever the time period is, and you use opportunistic, that's the key here. If things drop down, you buy in on the dips, if they make sense to do so. If you're using just a dollar cost averaging that just simply says, okay, we're just going to put 20% of your money to work in all the different investments that you have on a 5-month basis or so and get you all in, okay, that's one thing. But if you say, you know what, we're going to do a seeding of the portfolio to give you a baseline of 20% of the investments to start, and then on a monthly basis, we're going to look at a certain dollar amount that we're going to invest, if it's appropriate, up to a certain level, and utilize that absolutely on a date basis, and looking for those times to have the ability to find those times that maybe things drop or are going to start to see a rotation. So I think the idea of, if you're investing in stocks and there's a good name and it's moving, I'm not sure about the dollar cost averaging. If you're investing in funds and ETFs, and this is for the long haul, utilizing a sound investment discipline, I think it makes a lot of sense for the right person. If you're 20 years old and you got money and you just want to invest for the next 50 years and you don't care, okay. But a lot of people, as you notice from the questions that came in today, are concerned. So that's an issue. Next question comes in. Do you have any recommendation on online broker providers over the other? Are they all the same? Schwab, TD, E-Trade, Fidelity? All depends on what you're trying to accomplish. A lot of these have zero cost right now to trade stocks and ETFs. Some of them have much better charting capabilities. TradeStation is great for charting. TD Ameritrade through the Thinkorswim system is really, really good. Schwab has great customer service, incredible reports. We use them. We use TD. Interactive Brokers has the best execution probably that I've ever seen. We use those for our TDI managed growth strategy. when we're trading stocks, and especially when we want to go in and out quickly. So it all depends on what your flavor is. If it depends on what you're investing. If you're just investing in stocks and you want like a professional grade platform with unbelievable execution, Interactive Brokers. If you want charting, that is second to none. You got TradeStation. If you want to have kind of in between a little bit, you got the Thinkorswim platform for TD Ameritrade, although I've heard a few things about that. But we like them. They're generally okay. Next question. Not to be political. Uh-oh. Oh, boy. When you start out with not to be political, but what's your opinion on how the markets will do with a Biden win in November? I know you don't have a crystal ball, but uncertainty isn't something the markets like, right? Well, first of all, we have to get to who is going to be the VP candidate, probably coming in the next several days. Usually August is the date that the VP is announced for those running for president, at least historically. So we should be hearing something soon. The problem is that there was a lot of certainty surrounding the idea that when and if President Trump came in, there would be an incredible drop in the markets. It happened for 20 minutes. And markets were locked down after his win, and then he came out with a statement that he's cutting taxes. So it depends on really what the platform is going to be. We really don't know a lot. Some stuff is starting to sneak out about Biden's platform, about increasing taxes on corporations, but yet spending on the other side. It's very unclear. Right now, we know what we have, whether you like it or not. We have low taxes. We have a administration that is extremely focused on stock markets. Whether or not you agree with that as something that's smart for the total economy or not is another story. But they're very, very focused on that. And they'll almost do anything it takes to bring markets up. I don't think Biden will be so much in that camp. But it's really hard to tell because, at one hand, we have seen in the past a lot of promises made, a lot of platforms brought forth that just don't happen, even though they are, seemingly right. And it would seem to be that if Biden gets in, though, there would be the very high potential for a tax hike on the wealthy and a tax hike on the corporations. Now, with that said, I want to mention something else. There probably needs to be a tax hike no matter what. Fitch came out overnight on Friday, very quietly, and downgraded the outlook for the United States, saying that basically our fiscal house is not in order. We know that. Way too much debt. Deficit is out of control. And on top of that, taxes are low. That needs to change. We saw that with other countries around the world historically. And with interest rates and bonds as they are, there needs to be a plan to put this back together, because the amount of spending that's been going on over the last couple of years is absurd. Not to mention, take out this whole stimulus package that we just got and that we're getting. Aside from that, the tax income to the money spent is just not making sense. And that's why we have a debt to GDP that's just off the rails. It was going there anyway before all this. So either way, there's going to have to be something done eventually. Now let's move a little faster because there's a lot of questions today. Dave asked, if I roll my 401k over to Schwab, if I make another account so they don't commingle with my IRA, do these funds still have ERISA protection? Oh, my 401k. So, ERISA protection, you're talking about for the protection of claims of creditors, I assume that's what you're talking about. IRAs don't necessarily, well, state by state, there's some different things, but IRAs don't necessarily have the exact same. There's some papers written about this, about IRAs are still protected under some of that, and some of the laws that for the claims of creditor against the claims of creditors. But I would contact a tax attorney regarding that if that's something that's really important to you. If you're going to take your 401k over to Schwab, you just move it 401k to 401k. If you could do so, in other words, you open up a 401k at Schwab, you'll be the same whatever it is. But I don't necessarily think that a rollover IRA has the same. It will have the same issues with other IRAs. I don't necessarily think it's because it's from a 401k, because it will be just in an IRA at that point. But if you want to talk about that, we could do some research on it to find out really what you're looking for. and what protections you're looking for. Some may or may not be. I'm not sure what it is that you're looking for. So if you want to call me, do me a favor, call me or reach out to me. Let's look into that. I think that's an important question. Raymond says or asks, thoughts on residential real estate over the next 18 months, rates, pricing, and are you currently seeing the migration to Florida? And are there any specific ETFs you follow in that space? Residential real estate, is kind of interesting because it's not really a lot of, I don't think necessarily very actively traded and popular ETFs that work in that space. Because if you think about it, people own their own homes. So you'd have to have the stock of the companies that own those homes. The home builders are what you want to look at, I think, in that area. There's a few home builder ETFs that are there. And yes, there is a major migration. Just down the block from me, this is good for me, but it's bizarre. Just down the block from me on the water, I'm on the water. They're on a thicker part of the canal. House was sold in 2015 for $485,000, and today sold for $1.3 million. So that's good. The reason why I bring this up is that's a small house. That house was really, I was like, it's a 2x2, I think. Many of the houses in the neighborhood are much bigger. And that was like a small little house that almost is set kind of in a weird way to take up the land. The backyard's nice. It sits on the water, so that's all good. But we're talking about $1.33 million from $485 a few years ago, 2015. Wow. I'm happy for me. My house obviously is worth that much more on the water. But the point is there are a lot of people moving. A lot of people are buying second homes here. Airbnbs they're buying. A lot of renters are happening. And yes, there is that happening. However, you're really seeing a lot of that in the deurbanization process as people are moving from the city centers. That's a big issue that's happening right now. The ETFs you want to follow is probably, I would think, if this is going to be a big issue, is some of the home builders that are really having some bang-up numbers. D.R. Horton had a big number recently. You can find many of these, again, in ETFs. And then also, you want to look at some of the companies that are in the housing business, ETFs that are in the real estate area, like IYR and others, but they hold like Home Depot and Lowe's. But those are major also because if you buy a house, it's an existing home, you get the secondary point of having that build. We own real estate, but that's a broad-based real estate, doing very well with that. Had a big hiccup, of course, in March, but generally speaking, real estate, I think there's some real places that win, some places that will lose. The rents on commercial real estate in Manhattan are down 20 to 30%. Retail real estate is getting killed in city centers, obviously, and especially those that are in lockdown throughout the country. And that's going to take a long time to come back. Doug asks, what is a reversionary trade? So reversion to the mean. Reversion to the mean. What that means is if you take a long-term average of price over time, and you look if the price of let's say a company stock or a sector is well below, oftentimes you'll find that there'll be this reversionary trade. There'll be a pickup over time that there'll be, because it's down so much for so long, a move up again into where the mean, to get back to the average, the long-term average. So if you have a situation where you see a sector, let's just take an ETF, ABC ETF, that's a sector ETF let's use the real estate again, in the real estate space, that is down because the sector is down and it's been out of favor for a long period of time. Oftentimes we see over time the reversion or the reversionary trade to the mean happens. So that's kind of getting back to the average point. All right, let's kind of move fast. I'm sure you've seen the Office of Comptroller of the Currency's recent guidance on federally chartered banks and thrifts being able to provide custody services for crypto assets. Has there been any buzz in the industry regarding crypto? Any personal thoughts? I'm sorry, I can't, I don't know enough about crypto. I know enough about to say that it's not my thing. Obviously we saw that Bitcoin rocketed over the last, couple of weeks, along with like gold and silver. Alternative assets, non-US based, as the US dollar was coming down, has really done very well. I'm still not a big store of value guy when it comes to crypto, so I'm not the best to answer that. I'm sorry. Steve, Andrew, thank you for holding these bi-weekly and weekly meetings from about 140 miles north of you in Vero. We're doing fine in the storm. I don't know, have you given your time this way? I don't know. I know you don't have to give your time this way. I'm not ready for you to manage my portfolio yet, but I'd like to support you in some way. What's the best way? Just to thank you right now is just fine. I thank you very much. It's all good. One day I know you'll be ready, and then you can have me manage your portfolio. But right now, a nice thank you is really great. Alex mentioned he's 41. Yeah, so Alex, I think that was the question back about dollar cost averaging. You're not going to use your money in your retirement plans for 25 years. The best thing for you to do, if you're, I don't know if you were the frozen one or I think you were frozen, right? Let's see. Alex, yes, that reminds me. Yep, I just look at the questions we answered. You're 41, so you have a long time. It was a retirement plan and a non-retirement, so a chunky retirement plan. Okay, so your non-retirement plan, but you're not going to be using that probably for long. The point is, what is the point of this money? Is it money you're going to use tomorrow? Possibly. But if it's money that's truly investment money, dollar cost averaging, utilizing the plans I talked about is probably the best thing to get you unfrozen. Let's get you unstuck. Alex, let's get you unstuck. Craig, yes, it says, an idiot friend of mine got into a hedge fund where I lost money when the Dow goes up. I don't know. I know we're going to drop. I know the Fed is going to screw up and go negative. I know I'm right, but I'm losing money. Not sure what to do. Any help appreciated. It's investing, right? I mean, you could think either side of this equation. If you think you're right and the hedge fund is positioned properly and you believe this is going to happen and that is your best thing, first of all, don't have too much in there. That is going to be a real problem for your life. But if it's something that you really believe in and if they're doing what they're supposed to be doing, that is. If not, then I guess take your money out if it's not something you're happy with. Best I can give you. Last question, Ben. This goes with the 1 foot in and 1 foot out question, but I keep hearing about the concern of impending crash. At the same time, this presents a large wall of worry, and the key reversal indicator seems like the most it goes back to an equilibrium. That doesn't mean it's at odds with does that mean the odds of an unanticipated drop in the near market is low? No, listen, the way this market is working, the way the news flow is going, the way things are happening with this virus and all that, first of all, even if we do have a big drop, the Fed's then going to step in. That's the thought. Even if there's a big drop, the administration is going to come in with some kind of stimulus. That's the thought. That is what's going on right now. Everybody believes that there is a significant amount of backstop from every angle out there. So what's happening is that, and what you're seeing right now is that the belief is that, yeah, there could be a drop, but how bad is it going to be? We have companies that are doing better on the headline earnings piece, so well, what's the worst that can happen? And even if we come back 10%, what does that mean? A few hundred points on the S&P 500, big deal. We were just there a few weeks ago. So I think that's the kind of overriding theory that's going on right now with people, that they're really not too concerned. And I think that is creating some complacency, but at the same time, opportunity. So the key reversal indicator, when it goes into equilibrium, basically says that, you know what, people are kind of in between. The trend as we see it right now will kind of continue. And by the way, for those of you that don't know, the key reversal indicator is a plugin that we developed for TradeStation. It basically tells us psychological reading on what's going on with markets from a big picture. And you have to kind of step back. It's a long-term look at things, big picture. And the bottom line to this is that we've seen a little bit of overheating. We saw some last month, and we saw that 1,800-point drop, or 2 months ago, of the markets over one day. That may happen again. We're starting to see that, there is a lot of froth built in, but nobody seems to care because we're being nudged, we're being primed, we're being prodded to believe that it's okay if the coronavirus continues to spin out of control. It's okay that there is a significant amount of stimulus in the markets and debt repayment that have to be made in the future and that we're pulling forward. It's okay that the technology is leading the market in such a perverted way, but who cares? It's okay that we have stocks that are up 100, 200, 300% over the last 3 or 4 months, whereas it's all on an idea that could collapse if we go back to normal. But you know what? Let's play with it as it is. So I think that that's the whole point of this 1 foot in, 1 foot out, right? That's the whole substance of this and why it's so important to really understand this. Because right now, in probably all of my career in 30 years, I have never seen a situation that is this, the word divorce from reality, that there is such a bifurcation from reality, or there's something out of whack right now. However, I think we'd all agree that if 3 months from now the market corrects dramatically, we'd be like, oh, that made sense. Makes more sense than what's happening now. However, if you have this 1 foot in diversification process of dollar cost averaging set up, you can take advantage of that. Without that, if you're just worried about what's going on, or if you're not diversified at all, that where you can move around, if you don't have any positioning at all in the markets at this point, and you're just sitting in cash outside, kind of squirreled away with the money, locked down, not having someone work with you with it or doing it yourself with a plan, there's nowhere you can go with that. So I think it's really important to be properly situated, and maybe, you know what, that doesn't mean you have to get all the market returns right now. Get decent returns right now. Slowly but surely build the portfolio and grow. Slowly but surely build and grow. Let the portfolio grow over time. That's how you create wealth. It doesn't have to be, oh my gosh, the market's up 5% this month. I only made 3%. I'm miserable. No, you made 3%. If you do that on a regular basis over time, not one time, but over time, you're making money over time. That's how portfolios grow. That's how you create wealth. We're going to end it there. I want to thank everybody for joining me. We'll be around again next Monday at the same time, same station, if you will. Also, DH Unplugged will be tomorrow night. Great conversation this week on the Disciplined Investor Podcast with Ben Hunt talking about grifting, the great grift. Make sure you listen to that. Thank you again for joining me, and I will see you again next week. Bye.